Watch for specific imbalances, not typical past patterns. That's what Gary Schilling had to say about the current economic situation we're dealing with today. When you look at the repo crisis, which caused havoc in the financial markets, it was clear that something was broken. We've seen the Fed intervene before, but this was odd. They refused to admit anything was wrong. They refused to let the public know about the intensity at which they would need to intervene. It was brushed off, and the markets loved it. Since QE4 began, the markets have moved up in a straight line. No questions whatsoever. This happens to ring a bell. You came here for the truth, so let me unveil that for you. Today we're going to have a very interesting video, the first for 2020. And we're going to go back 20 years. This is something that really has not been discussed before. Even with all the news about the repo crisis, I didn't see this being talked about, and I wanted to show it to you. First of all, we're going to go back to 1999. Cash is flowing like champagne for Y2K. The volume of cash at the Federal Reserve has temporarily given to the banks to avert potential year 2000 strains is rising to dizzying levels. Check this out here. If you remember what happened during the repo crisis and how intense that became at its peak, it's gone down significantly since then. We know we've come a long way, including nearly $20 billion it gave to the banking system in the form of term repurchase agreements. On Monday, the Fed has almost $100 billion in hard currency loans outstanding to banks. That's the most money lent out through repurchase agreements ever, and clearly we've gone far beyond that. The idea this year is to keep banks flush with cash in case consumers withdraw large amounts of money before year end. Should bank computers fail to register the year 2000 and crash, or if panicked customers withdraw piles of cash, then the banking system would come under considerable strain. And apparently, giving out some repos is going to fix the problem. Well, they tried everything. They did everything they possibly could to make sure that money was flowing, that the currency kept on moving. And you know what happened with Y2K. Obviously, it didn't turn out as they expected it, but this is the way things go. It could come from any direction. We don't know what's going to happen. We don't know how crises will unfold. And in many cases, things don't expand the way that some people like to believe they will. But you better believe there's going to be some individuals, groups, or corporations that are going to take credit for something they didn't do. This chart shows us from 99 into 2000. Not QE, looks a lot like Y2K. This is the Federal Reserve's balance sheet. It expands to a great degree, and then it comes down after it's all over. Now, things look a lot different with the Fed's balance sheet after 2008, but this just gives you an idea of how things came to be. Fed supplied repo to the market during Y2K. Similar to the Fed's balance sheet, you can see how it goes up considerably and then comes down afterwards. I'm interested to see if they can actually pull this off. You know as well as I do, the market has looked extremely weak without the Federal Reserve, without interest rates being low, without all the money printing happening. Do you really think that they can pull out QE4, that they can stop it when they say they're going to? Are they going to really prevent the market from getting that juice it needs in April, or is it summer of 2020? I don't think so, but who knows? Fed supplied repo to the market. There were a couple events previously that we saw how the Federal Reserve had to intervene and make it happen, trying to use their repo facility in order to keep the cash moving through the system. But nothing, absolutely nothing compares to the events that we are dealing with right now. So the amount of repo that are being done on a daily basis has really declined. The numbers have come down quite a bit. It's approximately, let's say, 20 billion plus, and that, even though really it is a big number, it's small compared to where they were constantly being oversubscribed. The demand was there. Things have certainly changed, but I want to see where it goes because ultimately nobody understands the repo business. It's convoluted, it's confusing. People who are in the financial industry dealing with this type of activity on a regular basis, they don't even understand it. But all they know is everybody involved is basically saying, saying, Federal Reserve, do everything you can do to keep this machine moving. We don't want to see not one single down day in the markets. Even though the Federal Reserve, when you look at their so-called official mandate, pumping up assets is not one of them. However, they seem likely to take part in that. Let's look at this chart. NASDAQ bubble peak in 2000. The top chart is the index level and the bottom is the percent change from 99 into 2000, just to give you an idea of what has happened. S&P 500 repo rally in 2019. Many individuals have begun to draw some parallels in between what we saw just recently with the repo crisis unfolding, where the direction of the stock market has gone, and what we saw 20 years ago. So this just shows you right here from September into the end of the year. Clearly, as soon as QE4 began, the markets took off. It's been going up in a straight line. Ultimately, what we had was the S&P 500 struggling, really struggling to surpass that 2,800 mark. And then we got to a point where they couldn't surpass the 3,000 mark, and it was bouncing around through that range. But as soon as QE4 came into play, it seems like nothing has stopped it. Now, this is similar to what the events were in 2000, and ultimately we see familiar patterns. It doesn't necessarily mean it's going to be the same thing and have a dot-com bubble 2.0. It's just pointing out the fact that in many ways, they look a lot similar. It's not necessarily like 2008 where we have the fraud, the CDOs, and so on, but we do have other things that have been building up like crazy. Obviously, we have the CLOs, which have grown considerably. They are rotten to the core. Everybody knows about that. The corporate debt, particularly in the BBB rated debt, being an issue that has been brought up by individuals like Jeffrey Gundlach and others. Any and all protections that were put in place after the financial crisis have been removed. They want to move forward and accelerate this bull market to heights that are impossible to sustain. When there are corrections, when the market falls by 10% on a fairly regular basis, that's healthy. The market should not move up in a straight line. It should come down. It should move back up. It should come down. It should move back up. And of course, the general trend should be on the way up, but in a healthy pattern. If it goes up in a straight line, like for example, Japan in the late 80s, and you will see that it just goes up and up and up and up and up, and it gets to this euphoria stage where everybody is jumping in. You see people expanding to the absolute maximum. And then what occurs? Well, of course, we're looking at a time in which Japan still cannot get back to that. It's decades later. All of that money printing, and where did it get them? 1% on their fake GDP numbers? Come on. The growth isn't there. Okay? It's not there. Take a look at this. Powell puts are half of this year's gains. Should that surprise anybody? I mean, come on. Does anyone actually believe at this point that QE and low interest rates are not the only reason why the market has done what it's done? Now, I know there's a group of people that will say, yes, I know that the Federal Reserve is responsible for this. I know the market is screwed up, but I just want to put my money in because I want to ride the wave. And that's totally fine. Whatever you want to do, I really don't care. You have to do what's right for yourself and for your family. But we have to acknowledge the truth. My goodness, take a look at the information. Draw the conclusions for yourself. All the numbers are here if you want to see for yourself. Basically just showing you the fact that it is clearly a major contributing factor that when Powell comes out to say that we are going to cut interest rates, that we're going to use QE4 to make sure that nothing's going to be a problem to get those reserves up and the balance sheet expands at the fastest rate it ever has in history. Yeah, that does impact the markets. Speaking of markets, you can look at different asset classes and try to make judgments based on what is happening in the economy and, of course, in the cycle. This was throughout 2019, and you can see the change in value for selected asset classes. The S&P was at approximately 30% return, gold nearly 20%, and then look at the very bottom. Fancy colored diamonds were actually down. Now, how often do you see diamonds returning less? Fine wine and classic cars performed even worse. This tells you something is going on. Where the people with money are actually putting their wealth doesn't seem to be in that fine wine and classic cars. Maybe they're putting their money into the stock market, or they're waiting on the sidelines, not doing either. That's up to your interpretation. I need to get some new data from the EPFR to really be able to determine what's going on. Look at this economic factor that nobody can deny. Sluggish recovery, real GDP growth during expansions. Take a look at the very right-hand side. You're seeing something that I think should be on everybody's radar, and that is this growth that's barely there. 2%, and we're talking about fake 2% today. Years ago, they were calculating GDP more accurately. Today, it's falsified in order to look better than what it is, just like all the other stats, of course. But the general trend has been down, and down. Why is this the case? They've been printing more money. They've been expanding the balance sheets. They have been creating more stimulus packages. Oh, it's the new economy. Oh, that's the way things are today. But that's really not a good excuse. That doesn't explain the situation. And the fact is that they screwed things up. All throughout these periods, you have had intervention by the government. You've had intervention by the Federal Reserve. And we have seen the maximum amount after the financial crisis. And yet all of this period has only made things worse in so many ways. People can't afford homes today. People have to finance everything to be able to afford it. Their wages have barely increased in nominal terms, and they've declined or stayed flat in real terms. That is a troubling sign for the future. We have these extreme imbalances of rich and poor people, and a lot of people who have their 401ks and so on, they don't even realize that every so many years they get wiped out, and then they just put their money back in. It's like goldfish memory, and they can't figure it out. Why? Because they're trying to keep up with the Kardashians. Take a look at the overview of the World Economic Outlook projections. Go through this if you're interested, all these different countries, what they think the growth will be. The projection for advanced economies is 1.7% throughout 2020. Have they ever been right about this? Well, according to their projections, yes, they are correct. They're right on the money, but time and time again, I see them lowering the bar. At the very beginning of this video, I referenced Gary Shilling. It's from this Bloomberg piece, and I just wanted to touch on a couple points really quickly. Right from the top, the US has experienced its slowest recovery from a recession in the post-1940s era, and the longer it lasts, the more evidence there is that normal cyclical patterns are missing. Now think about that for a second. He makes a good point. Sounds a lot like the money GPS to me. I'm talking about the market being broken. The financial system is broken, and this is because of what they have done with their intervention. He talks about that right here. The Federal Reserve shifted from easing credit to tightening following past downturns, with its target Fed funds rate normally raised within a year or so of the recession's trough, eventually precipitating the next economic contraction. This time, the central bank kept its policy rate at the recessionary lows of essentially zero, which is 78 months into the recovery, and then after 9.25 percentage point increases, it revised course early this year with 3 rate cuts. At that point there, people understand that, they get it, they know what's going on. Why is that a bad thing? He explains it down here. Far from the Fed's normal worries about an overheating economy and inflation, the central bank frets that low and even declining consumer prices will spawn deflationary expectations. Buyers will hold off in anticipation of lower prices. Inventories and excess capacity will mount, forcing prices down. The price cuts confirm suspicions, and purchases are delayed even further, sparking a deflationary spiral. A glaring example is Japan, with deflation in most years in the past 2 decades and tiny real GDP annual growth of 1%. This is what happens over and over and over again. People don't see that, and of course, you know the result. The government has to step in, the Federal Reserve has to step in, and they create these wacky imbalances all all over the place. Look at the debt. Look at the deficits. Look at what's happening with the balance sheet of the Federal Reserve. Everything is screwed up today and nobody wants to own up to it. But eventually we have to pay the price. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me, so I do appreciate that very much. If you want to learn about business, if you want to learn about e-commerce, I have a free e-course, 100% free, no catch. It's available to you as my subscriber at theamazongps.com. If you want to know about the financial system, if you want to understand what the central banks are up to time and time again, they screw it all up for you and I. It's in these two books here. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Well now, have you seen this video? I think it would be really good for you to watch. Definitely click on it and I'll see you there.